Today, we're going to break down financials using TradingView's Statistics tab on Starbucks, ticker SBUX. I see a lot of people skip right over this section, but honestly, it's packed with information that can help you decide if a stock is actually worth buying. So let's dive in, and I'll show you exactly what I look at when going over the Financial Statistics tab. All right, so what we're looking at here is Starbucks Corporation's full statistics page. You've got your bar charts at the top showing price to earnings and price to cash flow ratios over time. And then below that, you've got tables breaking down everything from valuation ratios to profitability to liquidity. It looks like a lot, I know, but once you understand what each section tells you, this becomes one of your most powerful tools. Let's start with the key stats at the very top. You can see company shares outstanding, free float, number of employees, and number of shareholders. Right now, Starbucks has about 1.14 billion shares outstanding. That's important because those shares are what things like EPS and book value per share are based on. The free float is also 1.13 billion, which means almost all the shares are available for public trading, a good sign for liquidity. They've got 361,000 employees and 17,000 shareholders listed. Pretty massive company. This gives you a sense of scale right off the bat. Now let's get into valuation ratios because this is where most people start. The price to earnings ratio, or PE ratio, is sitting at 34.50. What does that mean? Basically, you're paying about $35 for every dollar of earnings Starbucks generates. Think of it like this. If you bought the entire company, it would take you 34.5 years to earn back your investment based on current profits. Is that expensive? Yeah, it's on the higher side. The market average is usually around 15 to 20, so Starbucks is trading at a premium. Next up, price to sales ratio is 2.48. This tells you how much you're paying per dollar of revenue. So for every dollar Starbucks brings in from selling coffee, you're paying $2.50 to own a piece of that business. Again, that's pretty high, but it makes sense for a strong brand like Starbucks. Price to cash flow ratio is 18.55. Cash flow is basically the real cash moving through the business, and this ratio shows you're paying about 18 times that amount. To put it simply, if Starbucks makes $1 in cash flow per share each year, and the stock trades at $18.55, that means investors are paying $18.55 for every $1 of real cash Starbucks brings in. That's what 18.55 times cash flow means. And why does this matter? Unlike earnings, which can be tweaked with accounting tricks or one-time write-offs, cash flow is harder to fake. It's actual money coming in and out. A lower price to cash flow ratio means the stock is cheaper relative to its real cash, while a higher ratio means investors are paying a premium for that reliability. Then you've got the price to book ratio, which is interesting. The last time TradingView recorded it was back in 2018, and it was 63.63. Whoa, right? Book value is what the company would be worth if you sold off all its assets and paid off all its debts. So you're paying 63 times that amount. That sounds insane, but here's the thing. Starbucks isn't valuable because of its buildings or equipment. It's valuable because of its brand, its customer loyalty, and its global presence. Those intangible assets don't show up in book value. After 2018, the price-to-book ratio goes blank. And that's because Starbucks bought back so many shares and took on debt that its book value turned negative. Once that happens, you can't really calculate a price to book anymore. Enterprise value is $112.75 billion. That's basically the full price tag of Starbucks, including its debt. Think of it like buying a house. You're not just paying the sticker price, you're also taking over the mortgage. Now, the enterprise value to EBITDA ratio sits around 20.62. Here's what that means in plain English. Enterprise value, EV, is the true value of the company, including debt. EBITDA is just a fancy way of saying profits before a bunch of accounting stuff. Basically, the cash the business generates from running its stores. So when you compare EV to EBITDA, you're asking, how many years of Starbucks' operating profits would it take to buy the entire company? At 20.62, investors are paying about 21 years of Starbucks' annual operating cash flow, a solid premium for a business this stable and recognizable. All right, now let's talk profitability ratios. This section tells you how efficient the company is at making money. Return on assets is 8.26%. That means for every dollar of assets Starbucks owns, it generates about 8 cents in profit. Not amazing, but not terrible either. It shows the company is using its resources reasonably well. Return on equity, or ROE, is huge, 136.51%. Wait, how is that even possible? Well, this happens when a company has very little equity compared to its earnings. Starbucks has bought back a ton of shares and taken on some debt, which shrinks equity. A high ROE can be great, but if it's this high, you gotta ask if the company is over-leveraged. We'll check liquidity in a second. Return on invested capital is 16.53%. This is a cleaner measure because it looks at all the capital invested in the business, both equity and debt. 16% is solid. It means Starbucks is generating strong returns on the money that's been put into it. Gross margin is 16.42. That's the profit left after you subtract the cost of goods sold. So if Starbucks sells a latte for $5 and it costs them about $4.20 to make, they keep 80 cents. 16% isn't super high, but remember, Starbucks operates on volume. They're selling millions of drinks every single day. Operating margin is 9.26%. After paying for labor, rent, marketing, and everything else to run the stores, they keep about 9 cents on the dollar. That's respectable for retail. EBITDA margin is 13.99% and net margin is 5.91%. Net margin is the bottom line. After all expenses, taxes, and interest, Starbucks keeps about 6 cents of profit for every dollar of revenue. Some people would say that's thin, but again, this is a volume game. 6% on tens of billions in revenue is still a massive profit. And this right here is why fundamentals aren't easy. You've got to look at the full picture. Is this a high-volume company, a luxury brand, or something in between? You can't use a cookie-cutter approach. Every business runs on its own formula. Now let's hit liquidity ratios. These tell you if the company can pay its bills. Quick ratio is 0.55. This is concerning. The quick ratio measures whether a company can cover its short-term debts with its most liquid assets, like cash and receivables. A ratio below 1 means Starbucks might struggle to pay immediate obligations without selling inventory or taking on more debt. Not great. Current ratio is 0.76. Same story. It's below 1, which means current liabilities are higher than current assets. For a lot of companies, this would be a red flag. But for Starbucks, they generate cash so quickly from daily sales that they can get away with it. Still, something to keep an eye on. Inventory turnover is 14.73. That's awesome. It means Starbucks sells through its entire inventory almost 15 times a year. Coffee, milk, cups, it's all moving fast. High turnover is efficient and reduces waste. Asset turnover is 1.15. For every dollar in assets, Starbucks generates $1.15 in revenue. That's solid efficiency. Moving on to solvency ratios. These tell you about long-term financial health. Debt to assets is 0.83. That means 83% of Starbucks' assets are financed by debt. That's high. The company is leveraged pretty heavily. Debt to equity ratio, the last time TradingView recorded it was back in 2018, sitting at 8.12, which means Starbucks already had about 8 times more debt than equity. After that, the ratio goes blank because their equity dropped so low that the ratio can't even be calculated anymore. Again, that lines up perfectly with that massive return on equity we saw earlier. When equity gets that thin, even small earnings make ROE look crazy. Long-term debt to total assets is 0.70, so 70% of assets are backed by long-term debt. Again, leverage is a tool, but it increases risk if things go south. Long-term debt to total equity ratio shows the same pattern. The last time TradingView recorded it was back in 2018 at about 7.82. That means Starbucks had nearly $8 of long-term debt for every dollar of equity, already very leveraged. After that, the numbers go blank because their equity dropped so low that the ratio can't be calculated anymore. Again, that lines up perfectly with the negative book value and the sky-high return on equity. Now let's look at per-share metrics. These are super practical for investors. Revenue per share is 32.17. Each share represents about $32 in revenue. Operating cash flow per share is 4.30. That's how much cash each share generates from operations. Pretty healthy. Free cash flow per share is 1.98. Free cash flow is what's left after the company pays for capital expenditures like new stores or equipment. $2 per share is solid and gives the company room to pay dividends, buy back shares, or reinvest. EBIT per share is 3.28. That basically means for every share you own, the company earned about $3.28 from its core business before paying any interest or taxes. Pretty solid. EBITDA per share is 4.79. That's even higher because it adds back things like depreciation and amortization, basically non-cash expenses. It shows the company's raw earning power before accounting for stuff that doesn't involve real cash going out. Book value per share is negative 6.76. Yep, negative. That's because of all those share buybacks and debt. Technically, if you liquidated the company, shareholders would get nothing. But again, book value doesn't capture brand value or intellectual property. Total debt per share is 24.47. That means for every share of Starbucks stock, there's about $24 worth of debt tied to it. Now, that might sound high, but remember, Starbucks uses debt strategically. They borrow to fund buybacks, open new stores, and expand globally. The key is whether their cash flow can comfortably cover it, and based on what we've seen, it can. Still, it's another sign of how leveraged the company has become over time. Cash per share is 3.95. Starbucks has about $4 in cash per share, which is useful for covering short-term needs. Net current asset value per share is negative 30.47. This is current assets minus total liabilities divided by shares. It's deeply negative, which reflects that liquidity concern we talked about earlier. Tangible book value per share is negative 9.89. That might sound bad, but here's what it means. Tangible book value measures what would be left for shareholders if Starbucks sold off everything it owns, buildings, equipment, cash, and paid off all its debts. It ignores things like brand value or trademarks. So when it's negative, it means Starbucks technically owes more than the total value of its physical assets. But that doesn't mean the company's in trouble. It just shows that most of Starbucks' real value comes from intangible things, like its brand, customer loyalty, and global presence, not its physical stores. Working capital per share is negative 2.39. Same theme. The company is operationally strong, but structurally leveraged. CapEx per share is 2.32. That's how much they're spending per share on things like opening new stores and upgrading equipment. Reinvestment is crucial for growth, and $2 per share seems reasonable. All right, so let's tie this all together. What does this actually tell us about Starbucks as an investment? First, valuation. It's expensive. A PE of 35 and price to sales over 2 means the market really believes in Starbucks' future. You're paying a premium because it's a reliable, dominant brand. Second, profitability. Strong. Margins are decent, ROE is through the roof, and they're generating solid free cash flow. Operationally, this company prints money. Third, liquidity and solvency. This is where it gets a bit sketchy. The quick and current ratios are below 1 and debt is high relative to assets. Starbucks is leveraged. But here's the thing. They generate cash fast so they can handle it. Still, if there's a major economic downturn and people stop buying lattes, that debt could become a problem. Fourth, growth and reinvestment. They're spending on CapEx, turning over inventory quickly, and maintaining strong cash flow per share. That signals they're still growing and managing operations efficiently. So yeah, Starbucks might be pricey, but just like their coffee, people keep coming back for a reason. And hey, hope this video helps you on your quest for profits. Catch you on the next one.